Let's talk about what your business could be worth. We all know that as a business owner, you've built your business up over many years, you've put your heart and soul into it, and you have an expectation that one day you're going to exit your business and pocket a lot of cash. But did you know that 80% of small businesses, or small and medium businesses of the privately held sector, 80% that go to market don't get a deal done? Now, of those 20% that do get a deal done, only half of them, or 10% of the whole market, end up getting a deal where they create a successful exit on their terms. And what I mean by that is they get to do an exit without having some sort of earn-out arrangement eat into their deal. The successful exit is where the deal is completed as per the original deal terms. Not to mention the fact that many business owners are hoping to grow their business and get it to the point where it becomes attractive and that they might get someone come and make an offer out of the blue. So we want to make sure that it's ready, that if you do get an offer out of the blue, that you're in a good position to take advantage of that offer. So what are we going to cover in this video? We're going to explore what are the 5 stages and the 21 steps or the 21 topics that you need to address to make sure that you can be one of those business owners to get a successful exit. We're going to cover how a business is valued and how we can identify the potential valuation of your business and show you the opportunities so that you can manage your exit and the timing of your exit and get the most from your life's work. So here's the 5 stages, and there's 21 steps spread across these 5 stages. And what I'm going to focus on in this video is what we have to do in stage 1. How do we identify the potential or the current valuation of your business? And we're talking about a current valuation through a buyer's lens. And we'll also explore what that valuation could be. What if you were to prepare your business and make it attractive to be acquired or attractive to be acquired by a strategic buyer, what is the potential valuation of your business? So by the end of this, we'll understand the process that you need to go through, a number of the things that we can address so that you can do an assessment on your business. And I'll even give you a little indicator at the end to get a fairly good analysis of your business of what the potential valuation could be. Quick bit about me, just so you know who you're talking to. I'm Daryl Bates-Brownsword. I'm the UK Managing Partner of Succession Plus. Most importantly, I've been working with SMEs in helping them grow, fund, and even exit over nearly 25 years now. And I host the Exit Insights podcast. And in that podcast, I'm talking to business owners who have already exited their business and asking them to share their stories. And also, importantly, I'm talking to the advisors that help them prepare for exit and make sure that they got a successful exit. That's the Exit Insights podcast, and you'll find it on Apple, Spotify, YouTube, wherever you get podcasts. Now, this is the big question. Every owner that I ask, what's the value of your business? Do you know how much it's worth today? And whenever I ask this question, I'll get a number of different answers. People answer it different ways. One of the first ways is, hey, I think the business owes me this much. They'll give some sort of a view or perspective of the business. They've got a feeling of what they feel the business owes them. Now, that's often the number of what they would sell the business for today if someone made that offer. I think it's worth X. Another answer is the answer they need, which is the number they need to fund life in their next phase, whether that be retirement or whatever else it is they're moving on to. But the answer to what's the value of my business is however much my financial advisor has told me I need to invest to keep living the lifestyle that I want to live. And another answer that I'll often get when I ask this question is, well, here's a buyer's valuation. I know that businesses like mine have sold for this in the marketplace, and I've got a realistic perspective of what my business could be worth through a buyer's lens. So they're all different answers to the same question. So let's dig into that and explore how that works and how all those numbers relate to each other. It's always important to know that if you know the realistic valuation of your business today, and you know the potential valuation of your business, if you do that 1, 2, 3 years before any anticipated exit, it puts you in a really good position to plan your exit and plan what's next. Okay, so here's a tool we call the valuation model. We just move through this at time. There's no scale on the time. We just move through at our own pace. And the vertical axis refers to the valuation of our business. So if you have a look at that light blue line, that's just a straight line. It just tracks the growth of your business over time. Now, I know that in reality, it's always a jagged line and we get good years and bad years, but I've just smoothed it out just to, for ease and over the period of time, we can always straight line the actual growth that's occurred and smooth that out. Now, if I talk to any business owners, and let's just say down here is where we are today. So if we say, hey, look, regardless of the number you think, a buyer will value your business at a certain amount today. And so that's where we are on this light blue line. And then when we say we understand the value, your aspirational valuation, or the number your financial planner has given you, what you want to sell the business for, your valuation, that's typically up here somewhere under this green circle, this green mark. And when I'm talking to business owners, what we find is, if they want to sell their business in 3 years' time and they keep doing what they've always done, the most likely scenario is that the business will keep growing at the same rate it always has. Unless you do anything differently, drastic changes to yourself, the economy, or what have you, it's likely that your business will keep growing in that same pattern. And in 2 or 3 years' time, when do you want to exit? The chances are you're not going to get the valuation you want, because it's often a bigger number than reality. Now, what we know is that valuation is a combination of a profit number, a representation of your profit, and some sort of multiple of that profit. And we'll dig into what these numbers represent and how we can influence them in a minute. But there are 2 ways in which we can influence the valuation of your business. The first one is we can increase the profit. So if we have a look and we have a look at how we can improve the best practice on our profit, how we can tweak things, get a CFO to help us fine-tune things, manage our money better, make sure we're not overspending. Whenever we work on the profit, it's typically a one-time fix. And that one-time fix results in a straight line, and it typically will improve the profitability of our business over time. But in most scenarios, it's not going to give us the number we want. No problem. What we can do is we'll get some quick wins from the profit. We can restructure, we can have a look at, we can do some outsourcing, we can manage our costs, but cost reduction is typically a one-time fix, and no one ever scaled their business by cutting costs. We need to manage costs, but we don't want to just cut them right out and go overboard. What we can do is work on the intangible assets and manage and reduce the risks in our business. And if we can create some assets in our business, intangible assets or even hard assets that are worth something, I'm talking things like brand, reputation in the market, IP, great revenue flow, predictable revenue, then the likelihood is that we can leverage our multiple. We reduce the risk significantly for the buyers. We make that future revenue really predictable. Then we can increase the multiple. And if we increase our multiple, that's going to have a much bigger kicker effect on our valuation. So that's why that grows up exponentially. Every business owner I talk to, almost without fail, if I ask them about what the average multiple is in their industry, they'll have an idea. If you ask them that, are they aware of any businesses that sold for a much higher number than that average multiple, they've always got an example. They often don't know why that business sold for a much higher multiple, but they know that it did. What I'm going to show you today in this video will give you some insight as to what are some of the things that we can do, that you can do to increase the multiple in your business and make sure that you achieve the exit valuation that works for you. You get your business exit ready when you're ready to exit, and we'll have those numbers that work for you in the time frame that works for you. So we want to make sure that if you want to leave in 2 or 3 years, that the valuation that you can achieve will meet your expectations. And if it doesn't, then you've got some readjustments to make, or you can either change the time frame or lower or do some planning to change your investments. Right, let's move on to the next slide. So here's the $1 million question, or the big question that every owner wants answered. Can my potential valuation, given the valuation potential for my business in the time frame I've got, can it meet my aspirational valuation? Will it meet my number that will fund life in my next phase? Will it give me the answer? Will it hit my freedom number? Will it hit my aspirational number? And that's what you want to know so that you can make some informed decisions about your planning. Okay, so what do we do? So the first thing you want to do is you want to get, this is at your starting point. You're at your business now. It's day one. Let's do an analysis of your business and let's figure out what realistically it is worth today. So we need to do a bit of a health check. We need to see where your business is financially. We need to analyze the profit and the multiple. We want to see where all the risks are. We want to see where all the things that will hold your valuation back. We also want to assess the exit readiness and the attractiveness of your business today by an informed buyer. So what we need to do is the profit and the multiple is we're analyzing the risk and the return. The multiple is a reflection of risk, and the less risk, the higher the multiple. And just in any investment, acquiring a business is just like any other business. If you put your money in the bank, you'll get a really low return and it's a really low risk. So risk provides a multiple, and that's why we want intangible assets. If you've got a brand, a known brand that gives a reputation and it attracts customers to you, and your brand and if you've got some IP and a proprietary methodology, and that all attracts customers to you, it reduces the risk of that revenue flow increasing once you, the founders, leave the business. If you've got your clients on contracts, if you've got them on subscription-based pricing and the revenue flow is really predictable, it's really consistent, and it's not choppy at all, you're reducing the risk. And it's those intangible assets that will help the clients to be happy to pay those, to lock into contracts or agree to contracts or to go onto subscription model because they're getting value. What's the profit number we use? So you may have heard of the term EBITDA, which is the number that a lot of people use. It's the standard, if you like, for measuring and using in the valuation formula. Now, EBITDA is a great number if you live in a bubble. It's not a real representation. It's a number that accountants and financial people use to assess and equalize businesses across, and to compare a whole lot of businesses equally. When you use EBITDA, it's good for normalizing businesses. NOPAT, net operating profit after tax, from a buyer's point of view, is a lot more usable. It's a number that actually measures your cash flow. Why do I prefer it to EBITDA? Now, we're still going to do a valuation and include EBITDA, but NOPAT is more useful because it doesn't take away things like interest and depreciation, and tax. All those numbers are or tax and interest are real numbers that eat into your cash flow. So we need to factor those in. Depreciation, it's one of those accounting things. If you need to buy new plant, you've got to buy new plant. It hits your cash flow. It's a real number if you need to acquire it. Depreciation is just a number that accountants use to spread their costs over a number of years over the theoretical usable life of that asset. So that's just one of the differences between NOPAT. Interestingly, some fairly high-profile people are also fans of using NOPAT as opposed to EBITDA when it comes to evaluating or evaluating businesses. So you might want to just stop the video there, pause the video there for a sec if you just want to read about Warren Buffett and what Charlie Munger have to say about the numbers they use when valuing a business. Right, so we're going to get into the Business Insights report, and this is the report that we would prepare once we've done all of this analysis for you and we've used the NOPAT and the EBITDA and we've assessed your profitability and we're assessing the risk in your business. We'll put together a report so that you've got a fully informed view of the starting point of your business. We call it the Business Insights report, and it covers the first 3 steps, or stage 1, that I was referring to earlier, the first 3 steps of the 21 steps. Now, I'm going to go through this. I'm not going to go into detail of this report, but what I'm going to do is go through all of the pages and give you an insight of what we cover in the report, just so that you can see what's covered and the importance of all those bits of information. If you want to dig deeper, we can provide, I'll show you something at the end of the video, a book or a download, a resource that you can get hold of for free, and you can find out a whole lot more. But I just want to give you an insight, an overview in this video today. So the report does a deep dive, if you like. We cover 400 odd data points when we do this. We look at all of your financial information, and you're going to see why we want more than 3 years of financial, or why a buyer wants more than 3 years of financial data. We're going to do a complete analysis of your non-financial items. We're looking for the intangible assets here. And we're going to have a look at what the risk is. And we're also going to have a look at the value potential. We'll calculate a value potential and we'll compare you to all of your peers. We'll have a compare of what your profit is to what best in class is for your business. Okay, we've got here the table of contents, and we just start by just sharing all of that and just collating all of the information that we receive. We'll give you a strategic overview. This is a bit like a credit score for your business. You've heard of a credit score for your personal, which assesses your attractiveness of whether a bank wants to give you some funding. This is a very similar score here for a business. How attractive is the business for funding or acquiring? And we break it down into the areas, as we've already discussed, the financials and non-financials, the operations, the people, the staff, and your credit risk, etc. And we're doing this report on a fictitious company called Smith Engineering. And this Smith Engineering is just, well, obviously we made it up. It's based on a real company, but all the data is actually fully anonymized. The client's aware we've done this and they're quite happy. But let's get into it. So the first thing we do is we do an analysis of the structure. We have a look. There may be some tax issues. It's important to note that we don't give tax advice. We'll identify if there is a potential risk there, and we'll point you in the direction of where you need to go. It could be back to your own accountant to just do a review. And that's a good point to start talking to your accountant to go, hey, look, I need to reset our relationship. Up until now, we've been looking at how we can often, minimize tax and run the business efficiently from that perspective. And it's a good opportunity to let your accountant know that you're starting to think about exit. And if there's anything that they need to do in terms of tax planning or restructuring, that will be attractive and help you get a pain-free and seamless exit as possible from a business company transition perspective. We then collate all of your financials. We go through the financial statements and we're starting to look for add-backs. Now, add-backs are all those one-off expenses that aren't part of your everyday. What buyers are looking for when they review your financials is they want to see what the financials look like. They want to see what the financials would look like if they owned the business. So if you've had a one-off legal case or something, or you've been paying a whole lot of consultants, or there's expenses for conferences that you normally wouldn't do, or as an SME, there are opportunities to be tax efficient. The owners or the acquirers are looking to what the accounts would look like if they owned the business. And that's what add-backs do. So we normalize the P&L after making adjustments for those add-backs. We then split the balance sheet into a finance balance sheet and an operations balance sheet. And we start to have a look at what the trend analysis looks like. And this is why we really want, ideally, 3 years of nice, clean accounts. At least 5 years is better. We plot the trend so we've got a nice visual of what's going on, so the potential buyers can start to have a view of your business, or an overview, when they start to look back at the history. So remembering this insights report is typically performed 3 years before you sell your business, but you'll be able to show the history because we'll update it for you every year, and you'll have a nice track record of the changes that the business has been making over time, and buyers will love that level of detail. Okay, there's the first financial scorecard, and we're starting to plot it in a traffic light system. Okay, we're having a look at the trends, and we want to have a look at the break-even analysis now. We're looking for the safety margin of how much turnover you can make before you're in financial difficulty. What do you need to make every year just to stay alive, to generate before you start? What's the revenue you need to generate before you start making a profit? Now, here's a real insight that business owners often don't already have. So depending on the size of your business, if you've got a CFO in the business, you've possibly already got this information. But if you don't have a CFO in place, this is often an insight. Now, we move to the revenue to cash and the free cash flow. What we want to do is have a look at what's the surplus cash generated from operating the business. This is the return that the owner can expect to have available cash for them to make payments as dividends or maybe even reinvest for future growth of the business. But free cash flow, what's that surplus cash that's available for discretionary options? Now we're starting to have a look at what's the sustainable growth rate. How much, with the current financial structure, this financial structures we've got in place, how much can the business grow before it needs funding? Now, this is really important because if you put a business plan in place that says, hey, I want to grow at 30% a year, and your sustainable growth rate is only 18%, you're going to have to look at funding. And here's another real powerful insight that you want to know at this point before you start putting those growth plans in place. If you can provide this information to a funder, they're going to see that you're really all over your business, you've got a good understanding of your business, and it'll give them comfort to go ahead and provide you with that funding. And there's a credit risk score there as well. Okay, so now we've got your sustainable growth rate, we've got your financials. We're going to do some research, and we're going to have a look at what best practice looks like in your industry. We'll do some research, and we'll find similar businesses to yours. Often it's not exact, or sometimes it's not an exact match, but we'll find businesses very similar to yours and the size and scale, and we'll see what they've sold for, and we'll see what sort of results they're generating, and we'll just compare you. We want to see what best in class looks like. Now, this often gives you some insight to see, are you overpaying salaries? Are you paying too much? Are you in an area where you need to pay more? Are you? What about your rent? How are you paying for rent compared to all of your peers, your competitors? We do this. This provides us with the information for the profit gap analysis. So we can see how profitable you're running your business, and then we can see what's best in class for very similar businesses. So that's how we do the profit gap analysis. We can see what's the potential for you to improve the profit in your business. So the same revenue, the potential, the opportunity to improve the profitability of your business, which will generate more cash and also make your business more valuable. It'll increase the valuation. We show the foundation scorecards and the strategic growth scorecard, which leads us on to where we're starting the non-financial analysis of your business. We're now starting to explore what are the intangibles? Where are the opportunities to boost that multiple? What are the things that we can do to reduce the risk, make the business more attractive? So it's common to see more red on these scorecards, often because these intangibles are invisible. They don't show up on the P&L every day. They're not highlighted. They're the areas where we're working on the business, and sometimes they're new skills that we don't have, and so they're important but not urgent. This information leads us to what the analysts and the technical people call a beta factor. Now, the beta factor is an assessment of risk, and it looks at things like the way the business is operated, the environment in which you're operating the business, the local economy. There are some things on this beta factor scorecard that you can influence, and there are some things that you can't influence. The reason we need to do this is that we need it to calculate your cost of capital. And the cost of capital is going to be, I'll talk about it in this slide. So we need to calculate the cost of capital. This determines the tax-free. What we're looking for is what's the cost of debt and what's the cost of equity, so that we can see what buyers can tell that what they're looking for. What's the best way to put it? Buyers want to see what sort of return they need to make buying your business as a good investment. That's probably the short answer to do it. What makes your business a good investment? So they're going to want to look at the return, and they want to compare it to your cost of capital, how much it costs to run the business. So what do? Here's where you'll need your accountants involved in this one. We'll prepare it for you in the Business Insights report, but you can see on the left-hand side, you've got the balance sheet data, and on the right-hand side, you've got the P&L. What's showing up in the analysis here for Smith Engineering is that Smith Engineering is generating a return of 26.7%, just over 26%, 26.07. What does that tell us? It tells us that buying Smith Engineering is a good investment, a good option, because their cost of capital was less than 26%. I think on the previous page it was around 20%. So the make 26 greater than 20 makes Smith Engineering a good deal. That's the sort of analysis that a savvy buyer will be performing. Now, let's be honest. This is the page that most business owners are interested in. Whenever we prepare a business insights report, they go straight to this page because they want to know they want the short answer. They want to know what your business is worth today, and you want to know what the value potential is for your business, and you want to know what the steps are to get there. An interesting insight here is that Smith Engineering can almost double the valuation of its business. It starts off at about 5 mil and it can go up to about 9 mil, and that's the value gap. There's about $4 million or £4 million here in terms of value gap, which has lost valuation. This is the valuation that if you prepare your business, you start to work at best practice financials, you make your business attractive to a strategic acquirer, strategic buyer, you can almost double the valuation of your business. After we've done nearly 1,000 of these Business Insights report, what we can tell you on our platform is that the average value gap is about 30%. So there's 30% value potential in almost every SME out there. Every owner-managed business, if they do the work, if they prepare their business, they make it attractive to be acquired, they can increase their valuation by about 33%. Right, let's go through this. So what we can see here is this first valuation, this first bar is as of today, the valuation's 5.1 or 5.3. If we close the profit gap and start heading towards best-in-class financials, we'll boost that valuation just by addressing the cost issues in our business and the things that are eating into our profitability. Compared with our peers and best-in-class, we can get that valuation up to 6.5. We then start working on the intangibles, the things that are non-financial in our business, the things that will hit the balance sheet upon acquisition, but they're intangible, so they're not on the balance sheet today. These are the intangible assets in our business, things that accountants normally have struggled to address and identify in their normal accounting reports. But buyers, goodwill is the term I'm looking for. Buyers normally call it goodwill because, or sellers and accountants call it goodwill because they don't know how to address the valuation in intangible assets. So these intangible assets that you're going to build in your business, such as brand, proprietary IP, restructuring your pricing so that you've got assurance of long-term contracts and viable cash flow. Close all those gaps and your business will be attractive to a strategic buyer. Address all your governance and you make your business risk-free, minimize the risks, get your business up to a size where it's attractive to a bigger buyer who's prepared to put the effort in to buy your business then valuation can go up, and that's where it here becomes attractive to a strategic exit. Bit more detail on the slide there, and let's see where we go to from here. What we've got now is we've got our valuation of the business. We've had an assessment. We can see what the business is worth. We can see what the business could be worth. Now what we need to do, if that gap's not going to close itself, you need to put a plan in place and you need to start working through all the items addressed and highlighted in the report, and we'll give you all that information. So we put a plan in place. Here's the plan. It identifies all the projects that you need to do to close that gap in the time frame you want. Typically you want to allow at least 2 years to address everything. The longer you've got, the more you'll boost the profit and the valuation. And it'll also give you an insight as to see your aspirational value. Do you need to keep working to close the gap to your aspirational value, or can that aspirational value, your freedom point number, be achieved within that 2-year time frame? Right, what do we need to know? So we've got a starting point. We want to know what the business is worth today. We need a plan of attack to close the gaps. You need with the plan, you can then assess your energy and go, how much energy do I have to keep working at this? How much longer do I want to go for? what's required. If you can get your head around it, then you're more likely to be able to put a plan in place and drive your business forward. If you want to find out more, I've put a QR code on the screen now. If you just hold the video, scan that QR code, you'll be able to go to our website and download a free copy of It All Begins with Insights. It All Begins with Insights is an ebook that will give you all the details you need in far greater detail and depth that I've covered here in today's video. And it'll just show you how we go through the 21 steps and how we build that valuation up. If you want to find out a bit more and you want to know the valuation potential for your business, we've got an assessment. You just take a few questions. It'll take you about 5 minutes and we'll send you a thorough, detailed report that will identify some of the things that are particular to your business. If you just drop me an email and let me know, I'll give you the details on the next page and ask about the value potential for your business, we'll set you up with an assessment. If you want to just have a conversation and if you've got some questions that apply for your business, by all means, reach out to us. But what you want to do is confirm that the valuation potential for your business will exceed your aspirational value so that you can do the planning and make sure that you get an exit on your terms. I'm Daryl Bates-Brownsword. It's been an absolute pleasure to share this information with you today. Here's all of my contact details. I hope you've enjoyed it. Put a like on the video if you've enjoyed it, and I'll look forward to catching you in another video soon.